Greetings, fellow investors. I'm Matthew Cochrane, a lead advisor at 7 Investing, where it is our mission to empower you to invest for your future. I'm joined today by my fellow lead advisor, Anirban Mahanti. Say hi, Anirban.
Hello, everyone.
And we're joined by a special guest today, frequent guest, Alex Morris, the creator of the Substack Science of Hitting Research, Investment Research. Alex, how are you doing?
I'm doing good. That's close enough.
All right. So today we're going to be taking a look at 7 stocks. As anybody who's paying attention to the stock market knows, we are currently in a bear market where meaning the S&P 500 and the NASDAQ are down well more than 20%, and several stocks are down more than that. In fact, several of the darling stocks that were beloved by FinTwit and growth investors over the last several years have taken severe hits in the last 6 months to year. So today we're going to be taking a look at 7 of them that are down by at least 50% from their all-time highs. And those stocks will be Netflix, PayPal, Upstart, Peloton, Block or Square, Okta, and Spotify. And we'll be taking a look at those, and we're going to let you know if we think these stocks are wrecked and they're not going to regain their all-time highs, or if they're due for a rebound and we'll one day see even higher highs than what's in their past. So we're going to lead it off, and you're going to be blown away by our special effects here as we transition. So if you're watching this on YouTube, we're going to share a few charts from our friends at Ycharts. But if you're just listening, we'll try to explain as we go. But the first stock we're going to look at is Netflix. So Netflix in the last 6 months is down 72% from its high. That's incredible. And its market cap, I mean, this was almost a $300 billion company. It's now down to about $84 billion. Alex, is Netflix a wreck or a rebound?
Well, I should start by saying, I think the first time I wrote Netflix up, I effectively said I think it's got a little bit ahead of itself. Maybe I dismissed it again, as I have for many years. Shortly thereafter, they reported a difficult quarter and the stock went down a lot. And I had a lot of people telling me, congrats, being patient paid off. That was a smart thing to do. And we are down very significantly since then. So sometimes the short-term swings, you can't put too much weight on what's happening in the very short term. I think Netflix is probably representative of the direction of decline that you see for most of its competitors. Anybody who's really in the, call it the premium video space, especially companies that are focused on kind of the VOD, video on demand opportunity, whether that's SVOD subscription or AVOD, ad supported service. The story really probably goes back to the start of the pandemic, when they had a 6-month period where they added, I believe it was 25 million subs, by far the strongest performance in the company's history. The numbers started to normalize as we came out of COVID. And as I wrote in one of my articles, I basically said, is this business going to return to kind of the low to mid 50s 2-year stack growth rate that it kind of exited at when the pandemic started, or are we looking at something different? In a perfect world, you're talking about the growth rate continuing to accelerate on an absolute basis, meaning on a percentage basis, you're kind of holding. What we've seen subsequently is the numbers have gone very much in the wrong direction. Management is talking about, basically a subscriber base barely growing this year, or not growing very significantly, a comment that seemed completely unfathomable, 6 months ago. Same time, it's having impacts on the P&L and what people think about the long-term future of the business. And also, you have a lot of competitor activity, as the chart here shows. Disney Plus launched in late 2019 and now has about 140 million paid subs. So it's 2/3 of the way to Netflix's global sub base on a much lower ARPU, but still 2/3 of the way to Netflix's global sub base in a very short period of time. There's obviously a number of other competitors in the market as well. And, I think this period, it's very interesting for a number of reasons. For one, I frequently tell myself or think about the idea of competitive advantages and thinking about what they mean on a relative basis and trying to understand competitive positioning through that lens. It's something that for me has been really instructive in the media industry and understanding something like ESPN. I think a lot of people misunderstand what the business is and why it was successful for so long. And I think there's a similar story at play here with something like Netflix. I think they really need to reassess where they're at now. And for a long period of time, I think they've been pretty clear that their operating focus was simply growth at all costs, whether it was internal spend, whether it was content spend. They had the justification for doing so because the sub base kept growing so rapidly and the recurring revenue base, which is now north of $30 billion a year, was growing so rapidly. When that slows down, it's time to sit down with a blank sheet of paper and really reassess what your competitive advantages are and where your focus should be. So, long story short, I have a lot of faith in this management team. They've been through difficult periods like this before. Most notably in the DVD days where they faced some real stiff competition in the mid 2000s, as I noted in a recent article. They announced their first price increase in 2004. 5 months later, they came back and said, we're actually cutting prices and going below what the price point was before the hike. So they have the ability to recognize when they need to make, pretty drastic decisions. I think the way they communicated the ad-supported tier was a little bit haphazard, but I think when you look at something like Nielsen data in the US, you have a pretty clear understanding why they think they need to go that direction. And again, that's a US, a market with very high income levels and ability to pay for something like this. So I think they have a lot of options at their disposal, some of which I think are quite smart and worth pursuing, and others that they probably will avoid. But I think they can find a path forward from here. But it's not a layup.
Is the main problem like the competition, Alex? I mean, right now we're looking at the run rate of streaming revenues for like Netflix, Disney, Warner Media, and Paramount. And I mean, this goes back to the first quarter of 2020. But like, if you go back before that, it was only Netflix, right? So is this the main issue? Is this just a new reality for them, do you think?
I think the answer is one that we don't know. And I don't think management knows either, by the way. In the shareholder letter, they gave basically 4 reasons for why they think they're seeing a slowdown now. Competition was one of them. They also talked about password sharing, which I think is something of a false narrative is probably not the right word, but I think it's a good problem for Netflix to have, which we can get into if we want to. They played that hand very well for the past 10 plus years. The other 2 are basically expansion of the TAM, things like connected TV sales, which I think I've seen data subsequently. I think Roku talked about it, that market's been under some pressure because of macro reasons and also, pull forward from pandemic and also supply chain concerns. And then finally, obviously, macro concerns with especially what's happening with Russia and the Ukraine. So I think we can't really pinpoint it at this point, in my opinion. But obviously, when they were one of basically 2 or 3 competitors, yeah, the market's very different today than it was, call it 3 years ago.
Right. Anirban, any thoughts on Netflix? Record rebound?
Well, I think I say Netflix's situation is mostly a function of competition. I think they've had basically from 2007 onwards until about 2019, they had a free runway. The only real competition was Amazon Prime. And I think that changed, and everybody basically came around the same time. And it also coincided with their US market being mostly, or the North American market being mostly, saturated, right? So I think, yeah. And so okay, here's the way I think. I think Netflix is going to rebound, but I don't think it's going to ever go back to what the highs it has seen. The other thing is that I think Netflix is no longer, I think Netflix was valued like an eyeball stock or a tech stock. It should be valued like a media company. It's currently valued like a media company. And I think going forward, it should be valued like a media company.
That was a brutal re-rating for it, like brutal.
That's, yeah, it's a brutal.
Tech, for lack of a better term, like you said, tech valuation to a media valuation.
Media valuation. And I think and I would say the third thing is that I think this is what I think I blame management. I think management missed the boat on sort of finding the next thing. right? So they've done a number of what I would call pivots, right? So DVD to streaming, streaming to original content to what next. That pivot they've missed, right? And that pivot could have been anything. And maybe they're waiting for technology to change. So technology hasn't changed enough maybe to allow them to do a pivot. They tried a few different things like nonlinear content and things like that, which really hasn't taken off. And the final thing I would say is just, there's no free cash flow in this business, right? And if all the free cash flow is in the tail, I don't know what the tail looks like, because if this is not the part of the tail, then what is part of the tail? So I think I have lots of question marks. The other possibility, or final thing I'll say, is that this company crashes to a 50 or 40 billion or $30 billion market cap, and then somebody acquires it. And I think I now have the belief that streaming is best as a part of a bigger bundle, not as a part of a standalone thing, because just standalone streaming is just so hard. Right? Those are my thoughts.
I think just real quick to add on there, because I think I agree with a lot of that. And I think, it's funny. A great CEO is someone who has strategic vision, who has the ability to communicate that vision to shareholders, and thus, has the capital or the cost of capital to effectively get there over a long period of time and going through periods like this. I also think great management is the ability to recognize when things change and to potentially pursue inorganic opportunities. And, streaming is a bad business is a widely talked about narrative. And I think what's pretty self-evident is if Netflix is a bad business, the subscale players are in a much, much worse place. So if that's the reality, I think you need to at least consider what's going to happen to this industry as that becomes a widely held belief. And Comcast, the news coming out that Comcast has been in discussions with EA, and regardless of if that deal happens or not, has a willingness to spin off NBCU, in my mind, is a huge change in the landscape. And, we'll see what it leads to. But I think you're seeing the industry react to this. And obviously, if you were gonna have 5 or 10 billion of negative free cash flow over a period of years to chase this prize, and the prize is now half as attractive or a quarter as attractive as it was 6 to 12 months ago, you just have to wonder what kind of outcomes we'll see in the industry as a result of that. And look no further than Warner Brothers Discovery, where David Zaslav is telling you as clearly as he can, they'll effectively do anything they can need to hit their numbers, and they'll cut content budget in a big way if they have to do that to get there. And these things will have an impact on the competitive dynamics over time.
The only thing I'll add, and we got more stocks to get to, so I'll try to make this really quick. But I feel like they missed an opportunity when their stock was high to go out and use their stock to acquire some IP, whether that was Paramount or Discovery or Lionsgate. There's IP out there. There's a finite amount of IP that has real value, and I just feel like they missed that opportunity. Trying to create all of it originally just feels like a very hard road to do, and it's a tough slog, because it takes a while for that content to gain traction. I mean, look, Top Gun 2, they're making a sequel 30 plus years after the original movie, but that movie still holds, it's still resonant with a lot of people and in consumers, around the world, but specifically in the US. And I just feel like, I wish they had, or I think they should have gone out and acquired some IP. All right. Next stock will be PayPal. And so PayPal is currently down almost 70% from its all-time highs. This is a year-long chart, and about a year ago is when it hit its high. Its market cap, this was a company that was approaching $350 billion. I mean, this was getting into real mega cap territory, and it is now sub 100 billion, down to about $90 billion. And I'm going to call this a rebound, guys. So there's still PayPal made a lot of mistakes, and the CEO in a recent analyst call said look, we got ahead of ourselves with guidance. They got caught up with the growth they were seeing during COVID, which at the time they said they were going to reach 750 million active subscribers by 2025 or 2026, something like that. Which at the time was almost double what they were when they called that at their analyst day. I think that was early 2021, and they had to withdraw all of that this year in January on their Q4 conference call. So in less than 12 months, they gave out this crazy guidance for growth and then said, you know what, we're walking that back. We're not going to hit those targets. On top of that, they've seen eBay coming off, which was which we knew was years in the making. Like they had signed when they spun off from eBay, they had signed a long exclusive contract with them. And eBay long time ago, years ago, said like when that contract expired, they were going in another direction for all their merchant acquiring on their back end. So the growth right now, so with eBay coming off and with some of the growth pulled forward from COVID, like the growth right now doesn't look good. But I still think and given management's mistakes, and they shouldn't have given that guidance, and to have to withdraw it in a year is just brutal. I think in hindsight now, I'm a little less mad at management than I was, because it seems like all management teams got caught up in COVID that benefited from COVID. I mean, going from Amazon, who overbuilt capacity for their e-commerce inventory, to almost every single other companies on this list that we'll be getting to in a second. But so many companies got caught up in that COVID growth, thinking they were seeing the new normal, and they weren't. It was like a one year, 18-month pull forward of growth for the next few years. And so growth is now slowing. But underneath all that, they still have 429 million active accounts. Customer engagement continues to go up. This last quarter, it went up 11%. So these consumers are now seeing a lot more, are using their PayPal accounts more, 11% more than they were, 11% more transactions per active account than they were the last year. They're still growing revenue and earnings, albeit slowly, because of eBay rolling off and all the pulled forward growth from COVID. I think we're going to see that reaccelerate. They have one more quarter where eBay is going to be they're lapping last year's results, which included eBay. In 2 quarters, that'll all be done. And as they come more out of the pandemic, I think you're just going to see that growth reaccelerate. And I like their underlying assets. I don't think they're a commodity. Yes, there's a lot of for a hot minute, it looked like there was a lot of competition for them, and a lot of these one-click checkout things like Bolt and Fast. Those things are fading fast. Yes, there are things like Apple Pay. Yes, there are things like Google Pay. There's Zelle. There was never going to be just one digital wallet. It's way too big of a market. And, on top of all that, the valuation got way too ahead of itself. I think we can agree, in hindsight, I mean, the price to earnings ratio, I mean, this, after being spun off from eBay, they were in the 30s for a long time. And then it kind of got re-rated up to the 50s. At the height of COVID, at the height of their growth, their PE ratio soared over 100. And it's now down to 26. So, we're talking about Netflix's brutal re-rating. PayPal got one too. I just think from this valuation and for the underlying assets, I think those are real assets. It's not a commoditized product with this many active users. So I'm going to call this a rebound. It's going to take a long time for them to get to their previous highs. I don't think this is a V-shaped recovery by any means. However, I do think from this valuation, it should be a decent investment going forward. Thoughts?
I don't have much thoughts on PayPal. The only thing I'll say is that a lot of company management should take lessons from Tim Cook about guidance. So all these companies basically went gaga over guidance. Tim Cook basically said, COVID, I am no longer going to give you any guidance. And basically they have not given, the only guidance they give is headwinds and headwinds and headwinds. I think that's really smart. Companies, if you can't give, if you don't know what's going to happen, just don't give guidance.
That's actually what their CEO said. They're just totally going to approach guidance different philosophically from now on, and just saying we need to be more conservative. We need to consider the worst case scenario when we give guidance and things like that. And management definitely messed up. I'm not trying to give management a pass here, but they have kind of given a mea culpa on this, and I think they learned their lesson.
I was just throwing an apple for good effect.
No.
No, I think that's a really good point on guidance, and it's a topic that's worth addressing more fully. And I wrote about this recently, the idea of having the right shareholders. And it's a very difficult thing for management teams to do, especially at younger companies where cost of capital and the stock price can be such an important part of the equation. And you get sucked into playing this game, and it's a false sense of certainty, basically. I mean, these companies, as we've now learned in hindsight, they didn't have any better understanding. I mean, Peloton, case in point, they didn't have any better understanding on how it's going to play out than any public shareholder did. And you get yourself in a very, very, very difficult spot if you miss things like that, and if you're really geared towards short-term financial targets.
All right, so our next company that we're going to be doing is Upstart. Anirban, Upstart is down over 80% from its all-time highs. What's going on?
Well, Upstart is a relatively new company which made call it the cardinal mistake of, being over exuberant with guidance, and then, withdrawing your guidance, resulting in what I would call a complete lack of belief in whatever management says. And it's a classic mistake that a lot of companies make, and we've just been talking about it. I think that's really what has happened. The couple of things, the macro condition. So Upstart is a company that provides a platform for lending. So it's a two-sided, think of it, a two-sided platform. On one side, you have consumers. On the other side, you have basically banks and investors who are, basically funding those loans. Most of its loans are personal loans. So effectively, the rate that you can charge is a function of the the underlying Fed rate, right? The big deal for this company is that it's able to actually automate the entire process of loans. About 70% of the loans are fully automated and instantly approved. So this is one of the reasons why the banks like it. But they've basically said that, look, while we're a platform company, we are still very macro dependent, in the sense that, as the rates go up, there'll be people in the margin who won't no longer qualify for a loan, or no longer would want a loan because the rates are too high. So the demand for loans is going to go down, which effectively has an impact on the company's earnings. The other big deal of this company is, and it's really early in the game, if you show the next chart, is the way it's sort of approaching providing lending. So this is a chart which basically says that for all the loans that they have given, Upstart buckets people into categories. So let's say A+, B, C, D, and E, based on their assessment of risk. And the interesting thing is that you could be an A+ category and your FICO score could be, say, 639 or below. You could be in E category, and you could still have a 9.2% loss for a 700 or above FICO score. So what basically they're saying is that FICO score is a very is a very one-dimensional tool. Of course, banks use more than that, but they use basically decision trees with a small number of variables. They're using machine learning to sort of figure out the prime among the subprime and the subprime among the prime, and sort of expand the pool. And they're expanding into other things like auto lending and so on. So I think I like to describe this company as, this is sort of at the Model 3 phase, if you want to compare it with Tesla. Whether or not it is able to take its models and expand into these other things that it is thinking about, and expanding its market and expand the amount of earnings it can make, is still largely unknown. We do know that what they're doing kind of works in one sector. If they're able to translate into the auto refinancing market or the auto financing market, that's about a 7 or 8 times larger market than the current market that they're addressing. So is it a rebound or not? This is a stock that I call a very high reward, a very high risk company. It's got earnings, it's profitable. It's actually got a PE of, I think, under 20 right now. For the amount of the earnings growth it has, the PE is really, really reasonable. But it is a very, I think, a high reward, high risk stock. This could easily 10x with some probability. It could easily half from here again. Just bear in mind. And again, it's at that transition point where we don't know fully whether or not they'll be able to transition into the other areas. But if it does, this will be one of the largest fintech companies listed in the US. So that's what I would say about it. So whether or not it's a rebound, it's hard to say.
There's definitely a lot of potential here. Like, do you think like the problem the market's having like was that they had taken some more of the loans onto their balance sheet in that, or do you think that's not a problem?
So I think the bigger problem is, as I said, is whether or not they believe management. So they've always had loans on their balance sheet because they use the balance sheet for what they call R&D loans. So they did a little bit more than R&D loans to sort of when the rates went really wild, they put some more loans on their balance sheet to sort of just ride it out and then basically sell it off. So I personally don't see that as a problem, but they apparently were surprised. And they said, well, we are no longer going to put any more loans on our balance sheet because clearly the market hates it. But again, that also is another example of management being naive. Basically, the management is now letting the market guide what they're going to do, which is also wrong, right? So I think they've got good technology, but they really are still trying to figure out how the public markets work. Then the other thing is that they're saying that loss rates on their loans have stabilized, but nobody believes them. The problem really I think they've got is what management is saying on the calls. Do you believe it or not? And I think the analyst community, the investor community is basically saying, well, we don't believe what you're saying because you keep flip-flopping. You give guidance and you take it away. You're saying you're going to put loans on the balance sheet, then you're saying you're not going to put it on the balance sheet. That's the problem they've got. And they really need to figure that part out. That you can't be a servant to the market. They've become a servant to the market. I think that's their bigger issue than anything else. Instead of the market serving them, us, they are becoming subservient to the market. I think that's the issue they've got.
Right. I mean, we're talking about like Netflix having a re-rating from being a tech company to a media company. And it's almost like this went from a fintech company to a lender. And that's, if they, until they convince the market otherwise, I don't know if they're going to get that former valuation back, even with they have like strong earnings growth. Is it still in the triple digits, Anirban, like their earnings growth?
Yeah, it's like 200% plus. Look, I think whether there is no doubt that they are in the lending business. I think that is, I actually think that is less of the issue. I think the issue right now is if you're making personal loans, what is the loss rate on those loans, right? And are they sort of below the levels that you expected? Management is saying, yes, they're below the levels we expected, but nobody believes them. I think they're basically thinking that the loss rates are going to go through the roof and then basically this thing is going to blow up. And if it blows up, then the investor community, which is buying the loans, will stop buying them, right? So it's a two-sided network, right? But what I say is that I think something is working because the number of banks that are actually joining their network is steadily increasing. So there are banks that are actually white labeling their solution. So that's what I'm calling there. So there is proof that stuff is working, and the banks that are in the credit unions and banks that are signing up, they are signing up and saying, okay, we are happy to drop the FICO score because I think this is working for us, right? But the analyst community is saying, well, we don't know, right? And then they're looking at the fact that, well, there was a period of time when the loans froze from the investor community, when the company had to fund the loans from its balance sheet. So that means you could think of that as the investor community having, not the investor as in the stock investor, but the people who are funding the loans from the JP Morgans and whoever, Goldman Sachs, they froze, right? Which means they're having second thoughts. So I think those are the issues that they have to sort of work through. And I think it's less about, I think that, the market doesn't know how to to value this company right now, whether it's a fintech or, I think there's just a lot of other questions, right? So yeah, again, I think in the fullness of time, we will know.
Sure. Alex, you have thoughts on this one?
No, I think that captures it pretty well. I learned a lot right there.
All right. All right. So our next company we're going to look at is Peloton. So this is this might be one of my favorite punching bags as of late. It is down 88 more than, this is like their year chart. Last year they're down 88%, but from their like absolute high, I think it's like, it's over 90%. Its market cap has gone from approaching like in the high 30 billion mark to now down to like a sub $5 billion market cap. Alex, what's going on with Peloton?
Yeah, the short and sweet of it all is they were a massive COVID beneficiary. The number of connected fitness subscribers, which is the people who are currently paying $39 a month for access to their classes and their instructors increased 6x from the start of the pandemic to today, went from 500,000 to about 3 million. Management, effectively believed that that would not slow down and that this was a step change in their long-term growth. And, they made some capital allocation decisions like buying Precor, and, they were starting to build a manufacturing facility in Ohio. And now some of these decisions very quickly look like they were a big mistake. In this past quarter, the number of new hardware sales was down. Hardware revenues were down 40% year over year. Inventories were up 50% year over year. The price of the bike has been changed multiple times in the past since September 2019. They have a new CEO, Barry McCarthy, who used to be the CFO at Spotify, and I think he has interesting ideas about how to reimagine kind of the business model and the lifetime economics or the lifetime value that they see from the average customer. In the short term, as he clearly said on the call, they have to focus on cash flows over growth opportunities, essentially. And they have a huge test coming up on June 1st. The price of the subscription will be increased from $39 to $44 a month, and churn has been very, very good historically. We'll see if that has any impact. If it doesn't, it starts to present interesting opportunities for how they can reimagine, the business model to some extent, and how they price the product on the front end, because they know that's the biggest impediment to new purchases. But even success on that front has its own challenges, because they're changing the cash flow dynamics of when they receive money from their customers. So there are a lot of issues to address here, and even success in terms of transformation will present some pretty significant challenges. But yeah, this is for my money, this is probably the biggest COVID winner to loser that I've seen.
I think that's right. So is it a wreck or rebound in your eyes?
I think it's very, very difficult to say right now. I said on my last write-up, I'm essentially in the mode where I'm watching and seeing how this goes and trying to get a really clear understanding of what happens as they pull some of these levers. We have very early data, and it's somewhat encouraging, but it's very early. And this price increase, if it results in a step change in churn, I think they have to go back to the drawing board. And as I wrote, I don't know what options remain from that point to truly think about this business in a different way. And that makes it very, very difficult. The other really important piece in my mind is they are clearly doubling down on the digital subscription, which is basically access to a lot of this stuff without purchasing the company's hardware. And this is their vision for how they get to a global business that has, tens of millions of subscribers. And I think that's a very interesting avenue to pursue, but it's also going to be a very difficult area to actually win in, I think. And it's a very long-term challenge. And, when you're talking about in the short term, the need to raise capital as they did, and, Wall Street Journal reporting that they're out looking to sell 15 to 20% of the company to secure, the financial stability of the business. The long-term opportunities start to go to the rearview mirror really quick when you need to worry about paying the bills.
And Anirban, what are your thoughts?
My laugh says it all. Well, look, I'm not a fan of any business that. So it's a good service with a poor business that I'd put. It's sort of in the same bucket as Netflix, just worse. They have to compete with, Apple Fitness on one hand, which is, it's going to be bundled with something. They have to compete with Strava and so many others, right? I mean, the digital subscription business for fitness is just very, very hard. I think it's a wreck, but I think it has what I call an acquisition potential, but although I don't know. I mean, Google has shown particular penchant for buying what I would call tier 2 assets in that space. So they bought Fitbit. This would be a natural acquisition for them because, nicely fit in, you have Fitbit, you've got a fitness component there, you just buy this digital subscription thing. And then I think it would be valuable as a bundle under the Google sort of umbrella. So that I think is the net outcome. And that's, I think, makes sense why they're focusing sort of on the subscription side, because then it becomes more valuable. Their Precor or whatever they purchased, that was just a bad idea. it was just good money thrown after bad stuff. Anyways, I'm not a fan of Peloton at all.
Yeah, I mean, they definitely have like loyal customers that love the product. I just think like we're talking about like all these companies that like saw the surge like at the beginning of COVID and now have like are having that hangover like from afterwards, right? Like and all I think almost all these companies probably fit that bill. The problem with Peloton is it's like, so we talked about PayPal giving like bad guidance. We talked about Upstart's management and like they're saying, oh, we're going to put loans on the balance sheet. No, we're not. Yes, and like confusing Wall Street and Wall Street just like hammering them for it. We're talking about like Netflix. None of those companies though made the capital allocation decisions that this company did, like, at the height of their like euphoria, going into like COVID. Like no, and those decisions that they made, they're just not like, it's not just guidance you can take back and okay, your stock price takes a hit. Like that's like real cash that's gone and essentially like wasted. It just those decisions really put them in a bad spot.
Well, to Anirban's point, once you start separating the hardware and the software from one another, the competitive dynamics are very, very different. And the only other thing I'd quickly add as well, to the comment on a tech company potentially buying them or a Netflix or anybody else, I think ATVI is going to be a real test to see if that Microsoft deal actually gets done. And if that doesn't, the narrative that big tech basically can't go out and buy, I mean, it's most acute has been most acute for Facebook in my mind. But the idea that we might get to a place where regulators just say these huge tech companies basically can't buy anybody, I think that's a real possibility that actually happens, which that's the floor that a lot of people have been talking about for some time. So
yeah, that's a net negative if that happens, because a lot of these companies will have no out. They're going to zero.
Yeah.
So yeah, I was going to quickly add. So on capital allocation, that's one thing Upstart got right. It did sell additional shares at $120. So they raised some money, put it on their balance sheet. Which I think
like
was
right
smart.
after they said they weren't, like, wasn't that like, hey, we're not going to raise capital, and then like a week later, like, oh yeah, we are. Or it was
no, they didn't do that. But I don't know.
That was
somebody else.
That was Peloton.
Oh, that was Peloton. Yes, Peloton did that. We are not raising capital. We don't need money, and then they raise money. Yes.
All right. So the next company we're going to talk about is Block, or as it was known for years, was Square. Over the last year, it's down 65% or 64%. But like from its height, it's down like well over 75, 80% now. This company I have a real love-hate relationship with. At its height, it was over $125 billion company. It is now a $45 billion company, which is probably more in line with their true potential. So the things they get right. So Square, like they have this huge network of sellers. They have on the Square, what they now call the Square side. Like that's their seller hardware that they give to sellers, and the software they give to small and medium-sized businesses to support their core business functions. And they have like consumers on the Cash App, which now like those consumers on the Cash App, like we're talking about like, while it's only 40 million monthly active users on the Cash App, like they use the Cash App far more than like PayPal account holders use their PayPal accounts. I mean, the Cash App accounts are very heavily engaged with the app. So if they can, and their acquisition of Afterpay was supposed to like connect these two user bases, and that's the golden goose. Because so once you have in a typical transaction, if I go to Alex's store, like he owns a food truck, and I use my credit card, and like I pay $10 for that cheeseburger or whatever, like by the time it actually hits Alex's bank account, well, the credit card network took a fee, like the banks take their fees, like so it's not, he's not getting the true $10 that I just paid for my meal. Well, all that money that's under the Square umbrella, if I'm a Cash App user and Alex is using like the Square like hardware and for payments for his small business, like now it's staying under the Square umbrella and nobody else is taking those fees, meaning like these are just very high margin transactions for Square. So that is like I love this part of Square, like the fact that that they have payroll. So like if Alex hires a Anirban to like grill the burgers in the back of the truck, like and Anirban takes his like because Alex is a Square seller and Nearby's using the Square payroll to like get paid and, direct deposited into his Cash App. I mean, like the more just that money has a chance to stay in this Square ecosystem. And granted, this is like, I'm just talking about like, this is still very small amounts, but the more Square can do this, it just becomes very, very high margin transactions. Now, there's just a lot of problems. And one, I think I have to question like Jack Dorsey's focus. Like when you saw like how Dorsey's been since he left Twitter as the CEO, and now he's off the board. And when he was on Twitter, he said certain things as the CEO. And when he left, he's like, hey, here's a quote: "The idea and service is all that matters to me, and I will do whatever it takes to protect both. Twitter as a company has always been my sole issue and my biggest regret. It has been owned by Wall Street and the ad model. Taking it back from Wall Street is the correct first step. In principle, I don't believe anyone should own or run Twitter." Now, mind you, he never said anything like this when he was CEO. And, and Dorsey's like completely focused on Bitcoin. He goes, "I don't think there's anything more important in my lifetime to work on. And I don't think there's anything more enabling for people around the world." That's what he said about Bitcoin. And the latest features, like in Square's like a very innovative company. They're always releasing like features that for their Square sellers or for their Cash App users. Well, lately it's all been revolved around Bitcoin. So on their last conference call, they're talking about like what the new features on Cash App, and they were all Bitcoin. Yes, I'm glad that the Cash App users like can buy and sell Bitcoin in their accounts. Like if that's something people want to like engage with their accounts, that's great. But now they're like, hey, you can, our latest feature is with an activated cash card, you can receive a portion of your recurring paycheck deposit in Bitcoin with no transaction fee. Or, it also made Cash App wallets compatible with other crypto wallets on the Lightning network. And that's a network that enables like faster and cheaper Bitcoin transactions. And it just seems like these are all the things that Square is focused on. And I'm not sure that's the best way to build out a digital wallet, at least beyond some like niche cases or right now. Maybe it's the future. I don't personally see that though. And even, it seems like a remote possibility at this point anyway. There would be time later you can work on this if that was becoming more apparent. And just his remarks about Twitter, like after he left, and with Square's mission statement, it's like to democratize like these, like, like to serve like the underserved banked in the world, and give them like democratized banking services that a lot of times like people on the Cash App side or businesses on the Square side like didn't traditionally have access to. And that's a great mission. I'm all behind that. But you wonder if the mission is more important to Dorsey than profits or anything like that. I think those are fair questions now. So I have a very love-hate relationship with this company. I've owned shares for the last 5 years. I was fortunate. I was fortunate to get in really early, but I averaged up a lot so that like, my position right now isn't like too up overall. And I'm holding my shares, but like, I do have real concerns, but at the same time, like I see some great potential too. Like I said, connecting those buyers on the Cash App side, those consumers, to the sellers on the Square side, like that's real potential. Like that really is like something that like no one else can really, like besides PayPal, no one else really can do. And Square seems like much more focused on that than PayPal is. So I can see this being a wreck or a rebound. Like bottom line, like it's not going to surprise me either way. For now, I'm holding my shares, just almost holding my nose about the like Dorsey and everything else, because I see the potential, but I really don't know.
This is somewhat anecdotal, but it's a thought I've had about these on the consumer facing portion of these businesses for some time. And it's, you think about something like Cash App, which clearly has served a role in terms of buying, selling, trading crypto. Venmo, very successful over the last couple of years. It's become an app that anybody who's younger uses all the time to send money to and from friends. I think moving beyond that core use case and becoming something bigger is a really big ask, and it's very difficult to do. And it's like a lot of businesses. I think people brand becomes something in their mind and they associate it with that activity, but to really change that and do more with it is very difficult. And you can look at BAC or JPM or even Wells, their digital customer bases have grown very, very, very significantly over the last 5 to 10 years. They're doing a pretty effective job, at least based on the data, of serving that customer need. And that doesn't mean that Square or PayPal can never figure these things out. I just think it's going to be very, very difficult to get a large number of people to change the way that they live.
And Anirban, you have thoughts on Square or any block? I'll always call it Square. It'll be years before I call it.
I don't have anything special to add to what you guys have said, so I'll just.
All right. So the next company we're going to cover is Spotify. Spotify is down over the last 6 months, down about 60% from its highs. Its market cap, it was approaching 50 billion. It's now basically at $20 billion market cap. Alex, what's going on with Spotify?
It's a very interesting story. I'd start with, on the user side, I think they've continued to do incredibly well. Over the last 2 or 3 years, they've added about 200 million MAUs, and that's basically the size of their entire user base at the start of that period. So they've had huge user growth. They actually haven't seen the hangover from COVID, and it's less clear if they were ever even really a beneficiary from that. It was a much, much less clear impact on their business than it was for someone like a Netflix. I think the really big problem is that management has spoken to some gross margin targets that, if you look back over the last 5 years, they've effectively added 100 bips of gross margin expansion per annum, which is fairly significant and would put them on a reasonable pace of getting to those numbers over time. The problem is that the vast majority of that benefit happened in the first 18 months or so of that period when they renegotiated their label agreements in advance of the direct listing, and the results over that subsequent period have been much less meaningful in terms of the gross margin expansion. I think some of that is explainable based on some of the things they've done in the business, most notably the investments they've made in the podcast space. A major issue has been the ability of management to clearly articulate what that means in terms of the numbers, and then most importantly, obviously, what the kind of payoff is over the long term. I think shareholders are very willing to fund that bet and take the risk of it working, but they need clarity in terms of what that means. And the company's talked about things like a la carte before. We haven't really seen anything on that front. They've talked about pricing increases, which they have taken in select markets, and they've talked about those favorably. And by the way, so have some other industry players. Some of the labels have also said that Spotify's churn in response to those price increases is very low. The problem, I think, is we're not seeing follow-on action on the back end, and really the actual impact for those price increases is relatively small. So I think it's always been a very difficult business. I think the path to it being a much better business was there and is there. I think this is partly a communication problem and partly just really figuring out what the business is. They have product market fit, but they need to show that they have power and the ability to command a reasonable share of the economics.
Anirban, I know you have some thoughts on Spotify, so why don't you take it?
Well, I'll make it quick. I don't like this business largely because I think it's just, so a business with 400 million subs that really still, that's pretty big scale. If you can't make money now, I would put my money saying that they're not going to make money. It's a very competitive market. Every other platform can, if you are Google, you should be doing podcasting. If Apple, you should be doing podcasting. If I'm a creator, I want to be everywhere, not just on Spotify. So yes, you can have Joe Rogan, exclusives. I think it's again an example of a good service which people love, but it's just a bad business model just by definition. I think that's the problem. And innovating in that space is extremely hard because what you do, you integrate with hardware, but you don't own the hardware. You create new experiences, but you don't own the hardware. So you really can't create new experiences. It's really hard to do that because you don't have the loop. So I don't know. I think, and then of course they're a crybaby. They like to cry to regulators saying, how I don't like companies which I basically say you're crying because you just don't have an innovative business. That's why you're crying, because there's innovation and disruption happening all the time. It's just that, your business is not innovative, and that's why you go and cry to regulators all the time. So Yeah, so I'm not a fan. If I have to make a prediction of all the list, I'm saying this one goes to $5 billion market cap from where it is. That would be my prediction. At some point, somebody might be, and I don't think anybody was going to take it out either, because there's nothing here on offer to acquire. If I'm Google, I don't need it because I've got Google Music. If I'm Apple, I've got Apple Music. There's nothing here that they can offer. So yeah, my bet if I had to make one bet, I'll bet on this one being the down. This is a wreck.
Yeah, it's an interesting example of a space where the Spotify play is a really good book about the company's history. It's interesting to think about the position they were in, call it 10 years ago, and the position some of their competitors were in, most notably Apple, which literally invented the podcast space. And you look back at the subsequent results over the next 10 years, and I think the data pretty clearly shows that, at least in terms of user acquisition and the like, and user engagement, building product that people love, Spotify has kind of swept the floor over that period. That's not to say Apple hasn't done anything right, but it's a massive company that has a lot of focus in a lot of areas, and Spotify is clearly focused on one objective. That doesn't mean it's easy. It's going to be very, very difficult, and it has been very, very difficult. But I think there's a path for it to get there, but it will probably require more aggressiveness in terms of how they operate the business than what they've had to do previously. And part of that is, to the point of this whole discussion, is stock price and cost of capital. And when the world changes, you need to reassess what you're doing and what the right path is to go forward. And we'll see if they're capable of making that show.
All right. So last one will be Okta. Anirban, this stock is down over 70% from its highs. Over the last year, it's down 68%. And this was a high flyer for a long time. But one of the most beloved like SaaS stocks, if you will. And its market cap is now $13 billion. That's from like over a high of $40 billion. What's going on with Okta in your run? You're on mute.
Sorry. Yeah. So with Okta, I'll say that some of, when it was 40 billion, probably it was, gone ahead of itself. When it's 13 billion, it's really become cheap. I think, some of that is that they acquired Auth0. So, there's, I think, some doubts whether they're going to write down Auth0 or not. And that's an accounting thing. Auth0 is actually growing really strongly. But you just look at, look, this company it's not that this company is vanishing. This is an enterprise services business, right? Its growth has been 63% with the acquisition. Its standalone growth last quarter was 39%, close to 40%. The thing I point out to people is it seems like Okta's days are limited, but it's got $2.7 billion of remaining performance obligations, right? That's the line below the subscription. Remaining performance obligation basically says that these are contracts that have been signed that are going to be, this is the amount of money that they're going to recognize in due course, right? This is not some, fly-by-night company. This is actually a real company. They made a few missteps, including one with, there was a hacking into Okta, which they handled, I think, badly. But this company is doing really well. It's good, it can generate a lot of free cash flow. It was generating free cash flow. So I will say one of the reasons the valuation went up is it was generating 15% plus free cash flow margins. Then they acquired Auth0, and then that changed everything. And then it went from being free cash flow positive, free cash flow negative. It went barely free cash flow positive in the last report. But you can see that negative movement, I think, has hurt them. The negative movement on operating margins have hurt them. But I think that nothing has fundamentally changed with this company. I hold it. I think again on the balance of probabilities, I think over a 5-year period, this is handily market beating. I really like the stock at this price. Again, as I said, a lot of SaaS companies have been sold off, a lot of cloud companies have been sold off, but every indicator of data point says that cloud is growing strongly. And even Splunk said their cloud is growing strongly. So that says something. Anyways, those are my thoughts.
So, Anirban, you've always said you don't want your company to be like a feature of someone else's platform. So how, in my mind, but that's what Okta is. So tell me why I'm wrong.
Yeah, so yes, so I think if you're a feature from a consumer point of view, if you're a consumer business and you're a feature, that is a really sucky position to be in. That's what has happened to Spotify. That's what's basically happening to Netflix to some extent, right? Peloton is the greatest example of that. I think in the enterprise world, it works slightly in a different way. First of all, to be like Okta, which is an identity provider, you have to have integrations with everything. So the more integrations you have, the more sort of, other people will integrate with you, the more valuable you are as a service provider. That's number one. Number two is that this is an enterprise business, right? So you sign deals which are, 3 years, 5 years long contracts, right? Enterprises do not change their software that quickly. Yes, it's a feature in the sense that, yes, you could get a similar sort of service from, say, Microsoft, but a lot of companies do not want to do that. A lot of companies do not want their eggs in one basket, or they might want an independent cloud provider for identity management, for example, right? So again, I think a number of reasons you want to be supportive of multi-cloud. You want to have, your eggs spread across multiple baskets. You have enterprise clients. You might have a better solution. You also, I think the final thing I'll say is that they've also got the acquisition of Auth0. I think in the long run is going to work out really well, because that really is the engine that helps build customer side identity management. So that's basically APIs and code, which I don't think many of the other companies provide. So I think they have built a strategic advantage there. And it's a big market. I think, they can live alongside Microsoft and so on. So this is a little bit beyond just a feature, and enterprise markets, I think, work slightly differently compared to consumer markets. If you don't want to be a feature in a consumer market, that's really a bad place.
Alex, any thoughts on Okta?
Just one point, it's kind of tangential, but I was looking at AWS revenue growth rates the other day, and I noticed something that I hadn't seen previously, which is, they saw somewhat of a tailwind. They were decelerating at a certain pace, and they saw somewhat of a tailwind throughout the pandemic, and that trend's starting to slow somewhat. And I read companies like Airbnb or Match or plenty of others who rely on AWS as their infrastructure, and it got me thinking, it's funny. We might get to the end of COVID in the fullness of time and be like, everybody who benefited from this ultimately faded off, and it was a temporary blip. And we've certainly seen, and looking at retailers now, you could see the sales results in categories outside of basically essentials. And as Target said on their call, our Q1 sales are basically 40% higher than they were in Q1 19, and they're not a big store count grower. So we'll see how much of that actually sticks at the end. And the answer may be that a lot of this was just a temporary bump.
Yeah, for sure. It definitely looks that way. So Anirban, Okta's a rebound in your eyes.
Yeah, Okta I think is a solid rebound in my eyes. Yeah.
All right.
Strong buy.
Well, that wraps it up. So that's our 7 stocks today: Netflix, PayPal, Peloton, Upstart, Okta, Block, and Spotify. I was trying to remember all of those on the fly. Alex, for those interested in following you, where can they find you?
Yeah, the easiest place is on Twitter at TSOH_investing. And then, as Matt said at the intro, I run the TSOH Investment Research Service. I send write-ups to subscribers every Monday and every other Thursday, and effectively, I worked on the buy side for about a decade, and I decided to take all the work that I did day to day and make that a product that I send directly to subscribers. And then anytime I do anything in my portfolio, I disclose those changes before they're implemented. So it's complete portfolio transparency, complete research transparency.
Awesome. Thanks for joining us, Alex. I'm Matthew Cochrane, and for Anirban Mahanti, we're 7 Investing, and we're here to empower you in your future. Have a great day, everyone.